Hi, my name is Aziz Fahmi bin Kamarubarin. My student ID is MDB 2311013.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Dinish Adam bin Don Karisman.
Hi, my name is Nur Fatin Amali binti Rosaiman. My ID number MDB 2311027.
Hi, my name is Nur Adila Sofia binti Abdul Rashid.
Hello everyone, my name is Nur Alalisa binti Muhammad Shafriza and my ID number is MGB 2311016.
Task 1. Calculate and analyze the performance of the company using historical comparison. The ratios used should comprise as follows. Question A. Liquidity ratio. For current ratio, the formula is current ratio equals to current assets divided by current liabilities. So based on Aeon's statement of financial position, we know that current asset is 769,193,000 and current liabilities is 1,499,531,000 divided by it is equals to 0.51.
Understanding a company's financial stability is essential for investor and one key metric to evaluate the debt ratio. So, this is the formula to calculate the debt ratio. Debt ratio is calculated by dividing a company's total debt by its total asset. For Aeon, the 3,364,531,000 divided by 512,231,543,000 which equal to 0.64%.
So for question C, we have three key ratios to calculate based on asset management. First, inventory turnover ratio. The formula is sales over inventory is calculated by dividing sales of 41,290,038,000 by inventories of 55,330,075,000 equal to 7.46 times. Second, average collection period, or in other words, is days sales outstanding. The formula is account receivable over sales multiple with 360 calculated by 586,49,000 dividing 41,290,038,000 multiple with 360 equal to 5.11 days. Lastly is total asset turnover. The formula we use is sales over total asset calculated by 41,290,038,000 dividing by 52,235,043,000 equal to 0.79 times.
The two key profitability ratios that we will be discussing today are the operating profit margin OPM and the net profit margin NPM. Operating profit margin OPM reflects the profitability derived from Aeon's core operations before accounting for non-operational expenses such as tax or interest. It helps us understand how well Aeon's operational activities are contributing to its overall profits. On the other hand, the net profit margin NPM measures how much Aeon's revenue remains as net profit after deducting all expenses, including tax and interest. This ratio shows how effectively Aeon is converting its revenue into actual profits. Both ratios provide a comprehensive overview of Aeon's ability to remain profitable and competitive within the retail industry. So, this is the formula for operating profit margin and net profit margin. In 2022, Aeon recorded an operating profit margin OPM of 5.11%, but this figure dropped to 4.70% in 2023. This decline signals a slight drop in operational efficiency, which may be due to rising operating costs, such as supply chain challenges, rental expenses, or labor costs. However, despite this decline, Aeon continues to generate profits from its core retail operations, which is a positive indicator of operational stability. Maintaining a positive OPM in the face of external challenges highlights Aeon's resilience and ability to adapt within the competitive retail market. Moving on to the net profit margin, NPM, AEON showed an improvement from 2.69% in 2022 to 2.78% in 2023. This reflects the company's better management of non-operational costs, such as interest and tax, over the past year. However, when we compare AEON's NPM to the retail industry benchmark of 6.16%, it becomes evident that AEON is underperforming in converting revenue into net profits relative to its peers. This performance gap suggests that AEON has opportunities to improve by optimizing costs, increasing revenue streams, and boosting operational efficiency to reach or even exceed the industry benchmark. Alright, so now I will pass it over to Danish to continue with the discussion on the two remaining profitability ratios.
The return on assets measures how efficiently the company is using its assets to generate profit. The formula for return on assets is net income divide total assets times 100. In this calculation, a net income of 114,832 ringgit divide total assets 5,223,543 ringgit times 100. AEON generates a profit of 2.2%. Lastly, the return on equity measures how effectively a company generates profit from its shareholders' equity. The formula for return on equity is net income divide ordinary share times 100. In this calculation, a net income of 114,832 ringgit divide ordinary share of 1,404,000 ringgit times 100. AEON generates a profit of 8.18%. These figures highlight AEON's ability to balance asset utilization and equity management in achieving its financial objectives.
Next is calculate quick ratio. Quick ratio formula is current asset, which is 769,193,000 minus inventory, which is 553,375,000 minus prepaid expenses 7,762,000, which we found the value in page 171, notes 12, and divided by current liability 1,499,531,000, and the answer is 0.14. Lastly, a quick ratio of 0.14 means the company has only 0.14 in liquid asset for every RM1 of current liability, indicating potential difficulty in meeting short-term obligation without relying on inventory or external funding. This low ratio suggests liquidity challenges, as the company may struggle to pay bills on time, while typical for inventory-heavy industry like retail. It still highlights the need for better cash flow management or increased liquid asset.
So for AEON inventory turnover ratio of 7.46 is slightly higher than the industry average of 7.1. This indicates that AEON is managing its inventory more efficiently than the average company in the industry. AEON is able to sell and replace its inventory faster, which could mean better demand forecasting, effective inventory management, or higher product turnover
compared to the industry, which is 75.3%. So this shows that AEON debt ratio is significantly lower than the industry average. This indicates stronger financial stability and a conservative approach to leveraging debt. AEON has effectively minimized financial risk by maintaining low debt level compared to its total assets, positioning the company to better withstand economic challenges. Let's move on to the next formula, time interest earned. This is the formula earning before interest and taxes, EBIT, divided into interest expense. 193,138,000 divided by 100,000, 524,000 equal to 1.93 times. AEON Financial Strategy set a benchmark for stability, making it stand out in the industry.
Now, let's analyze AEON's net profit margin and return on equity for the year 2023 in comparison to industry average to gain a better understanding of the business financial performance and profitability relative to its competitors. Aeon's net profit margin of 2.78% is far lower than the industry average of 6.16%. This suggests that Aeon had trouble turning a profit on sales as effectively as its competitors, either as a result of increased expenses or inefficient operations. Aeon keeps less earnings per ringgit of sales when its net profit margin is lower, which reduces its ability to reinvest or distribute profits to shareholders. However, Aeon's return on equity of 8.18% was higher than the industry average of 5.25%. This shows better resource allocation and financial management, indicating that Aeon was more successful in turning shareholders' equity into profits. A higher return on equity indicates effective management and the capacity to provide shareholders with value. However, it can eventually provide financial difficulties if it is motivated by excessive debt rather than operational effectiveness.
Today, we will be analyzing Aeon Company's financial performance by focusing on key profitability ratios and comparing them to the industry benchmark. These ratios provide valuable insights into Aeon's financial health and efficiency. Additionally, we will identify strengths and weaknesses in the company's performance and propose actionable recommendations to enhance Aeon's operations and increase shareholder value. Profitability ratios are a critical tool for assessing how effectively a company generates profits in relation to its revenue and assets. By understanding these ratios, we can evaluate whether Aeon is utilizing its resources efficiently, managing its costs effectively, and ultimately creating value for its shareholders. This analysis also allows us to pinpoint areas of improvement by comparing Aeon's performance with the industry average.
Aeon key strength lie in an exceptionally low debt ratio of just 0.64%, which is significantly below than the industry average of 75.3%. This highlights that the company's strong financial stability and cautious approach to utilizing debt by maintaining minimal financial risk. Aeon has positioned itself to withstand economic challenges effectively. However, a notable weakness for Aeon is its low time interest and TIE ratio, which stand at 1.93 times. This indicates that company earning before interest and taxes EBIT are only slightly higher than its interest obligation, reflecting limited flexibility to manage interest payment if earning were to decline. To address this, Aeon could work on improving its time interest and ratio. This can be achieved by increasing earnings through enhanced operational efficiency and diversifying revenue sources, such as expanding e-commerce platform or introducing loyalty programs. Additionally, the company should focus on further reducing its debt to lower interest expenses, thereby improving its overall financial health TIE ratio.
So for Aeon's strength is that they have a variety of business. They don't depend on just one thing. They make money from malls, supermarket, and online stores. This keeps them steady even if one part of their business isn't doing great. Aeon weakness is economic challenge, which can significantly impact their profits. Issues like inflation, rising living costs, and weaker consumer purchasing power make people more conscious with spending. This could reduce sales, especially for non-essential items. Additionally, intense competition in the industry adds to challenge, as customers may choose cheaper alternatives from other brands. To improve, Aeon should focus on growing digital. They can make their online stores and apps better so more people shop online with them. Using social media and online ads can also help keep customers interested and loyal.